Welcome back to the Money Loop, the channel where we break down money, markets, and investing concepts in the simplest way possible. Today, we're talking about two words that sound almost identical but confuse almost everyone when they first hear them: covariance and correlation. Now, at first, these sound very scary statistics terms from a finance textbook, but they're actually just tools for understanding how things move together. And once you understand the difference between them, concepts like diversification, portfolio risk, and market behavior suddenly become way easier to understand. So let's make covariance and correlation actually make sense. At their core, both covariance and correlation try to answer the same question. Do two things move together or not? Imagine two cyclists riding down a road. If they both speed up and slow down at roughly the same time, there's some kind of relationship between them. If one speeds up while the other slows down, there's also a relationship, but in the opposite direction. And if their movements seem completely random compared to each other, then there's probably little or no relationship at all. That's the entire idea behind both covariance and correlation. They both assume and measure relationships between movements, but they do it in slightly different ways. Let's start with covariance. Covariance tells us whether two variables tend to move in the same direction or in the opposite directions. If both variables usually rise together and fall together, covariance is positive. If one tends to rise while the other one falls, covariance is negative. Pretty simple. For example, imagine company profits and stock prices. If profits increase and the stock price also tends to increase, they have positive covariance. But here's the problem with covariance. The actual number itself is hard to interpret. You might get a covariance value of 5 or 500 or negative 2000, but those numbers don't immediately tell you how strong the relationship is, because covariance depends on the scale of the data. So while covariance tells us the direction, it doesn't give us a clean, standardized measurement. And this is where correlation comes in. Correlation is basically a standardized version of covariance. It takes covariance and converts it into a simple scale between -1 and +1. That makes it much easier to interpret. A correlation of +1 means two things move perfectly together. -1 means they move perfectly opposite. And 0 means there's basically no consistent relationship. So unlike covariance, correlation tells us both the direction and the strength of a relationship in a way that's easy to compare. Think of covariance as a rough measurement and correlation as the cleaned up, easy to read version. Imagine comparing two different pairs of investments. The first pair moves together almost perfectly every single day. The second pair also moves together, but much less consistently. Covariance might tell us both pairs move in the same direction, but correlation tells us how strongly they move together. That's the key difference. Covariance answers what direction do they move, and correlation answers how closely do they move together. And in finance, that standardized comparison becomes incredibly useful. This matters a lot in investing and portfolio management, because investors constantly try to reduce risk by combining assets that behave differently. If all of your investments are highly correlated, they'll probably rise together, but they'll also probably crash together. That's why diversification matters. For example, owning only tech stocks may look diversified on the surface, but many tech companies are highly correlated because they react to the same economic trends: interest rates, consumer spending, AI growth, market sentiment. So when one falls, many others fall too. Investors often look for assets with lower correlations, so their portfolio becomes more stable overall. But there's one important thing to remember. Neither covariance nor correlation proves causation. Just because two things move together doesn't mean one causes the other. Sometimes relationships are meaningful, sometimes they're coincidence. And in financial markets, relationships can change over time. Assets that normally move differently can suddenly become highly correlated during market crashes or periods of panic. So these tools are useful, but they're not crystal balls. So hopefully covariance and correlation feels a lot less intimidating now. Covariance tells us whether two things move together or opposite. Correlation takes the idea and standardizes it into an easy scale from -1 to +1. And that's why correlation is usually more useful in real-world investing. If you enjoyed this video, subscribe to the Money Loop for more simple explanations of investing, markets, and finance concepts. And I'll see you in the next one.